Welcome back, everyone. Okay, so last time we did these ratios, the profitability ratios, and what I probably didn't just mention really quickly is that, well, at the top, these are not profitability, right? These are growth ratios. This is basically, we're trying to see the growth of some account, and in this case, we're looking at sales. We're looking at from the top line, literally the top line on the financial statements, how well we're growing, right, over time, because that growth will give us a very good indicator of how the overall organization is going. And we can and we will look at those same type of changes over time in the future across other accounts. The rest of these profitability ratios, these are trying to find out just what it sounds like. How profitable is this business? And we can look at different levels of granularity of profitability. So gross to operating to net margin, and these give us an idea of how much money we have at different stages, after we remove different levels of expenses, right? And each of these would be important to compare against other companies in the same industry, right? Or even same industry in the same geography if it's a small business, because that will let us know, are we operating on a sound business model or a similar business model to how everyone else is, right? These down here, return on assets, beginning equity, invested capital, this is basically trying to say, okay, well, how much money are we making on the money we put into this business? Do our assets, are they returning capital to us? We put some equity into this company, we bought some shares, or when we started up, are we getting that money back, right? And the return on invested capital, very similar. So this is broadening the net beyond just equity and saying, what is the return to all the investors who are putting capital into this company, including debt lenders. And then finally, we look at our pre-tax return on invested capital, and that's just kind of saying, well, how much return do we have before we actually pay off our taxes, right? So what is that pre-tax return? So that's what that is. Now let's get into the efficiency ratios. All right, here we go. So these efficiency ratios, the next 8 ratios are going to give us some idea of how efficient we are generating sales from different perspectives, right? Or it's going to look at how efficient we're using our resources. That would be probably a better way of saying it. So we have assets, we have net working capital, inventory, how well we are collecting money, how long it's taking us to pay money, and how much cash we have for compared to our sales. All right, so the first one is going to be asset turnover, right? So asset turnover, we could go over to our cheat sheet. You can print it out as well and look through, but it's going to be our sales over average total assets, right? And so let's just do that one. Sales divided by average total assets. Close, and there we have it. And then we have our net working capital turnover, and that's just going to be, again, we're taking our sales, right, divided by average net working capital. Now I'm going to take a pause here, and let's do something down here at the bottom. All right, let's take our, let's call this one current assets, current liabilities, and then we're going to have our net working capital, and then we will have our average net working capital. All right. Now what I'm doing is I'm going to cheat a little bit on some of these formulas and make it a little bit easier for us. And we're just going to call this our net working capital worksheet, right? And let's just go ahead and block that off with a different color so that we know it's not necessarily the same as what we're doing on the other. So current assets, this is just going to be equal to here, our current assets, bam. And our current liabilities are going to be equal here. And then our net working capital is just going to be our current assets minus current liabilities. That's all net working capital is. Let's go ahead and put a line there. And now we can look at our average net working capital. Well, let's do this to the right. Okay. Now we can do our average net working capital, and it's just going to be the AVG. And yes, keep it, and we can copy that over to the right. All right, there we go. So let's go ahead and put that all into the same number format, like this. Okay. Now you'll notice really quick before we move on that the average, obviously if we have a period where it's positive, if we have positive net working capital, that means that we have enough assets to pay off our current liabilities, or enough current assets to pay off our current liabilities. A negative is a dangerous thing. That means that we don't have enough assets to pay off our liabilities, right? Or current assets to pay off our current liabilities. So when we take the average, if we have a period where it's if it's negative and a positive, that can be a little bit dangerous, right? So we might consider expending that out so that we would be able to get a solid positive number. But bottom line is we can even just look at our net working capital in one period. So let's do that. Let's just avoid the average because it's going to skew our numbers a little bit, and make a decision that we won't use our average. All right. So we're just going to take sales equals our sales divided by, and let's just take net working capital just like that. All right. So now we have our fixed asset turnover. So that's going to be our sales. Well, I have to click on the cell, not type sales. So sales divided by our, and what we would look at is for plant, property, and equipment. But in this very simplified balance sheet, it's just all rolled up as fixed assets, right? So that's what that's going to be. And what we're looking there is basically how much sales are we producing from our fixed assets, from our plants. Okay, days in inventory. So here we're going to look for our average inventory. You could also just do the inventory. The reason why we take average is because we want to flatten out any seasonality. So we're going to take our average of our inventories, and then we're going to divide that by our cost of goods sold, right? That's going to be up here at the top, cost of goods sold, divided by a 365. And what that is telling us is, the cost of goods sold is a book value of the cost of units that we are producing, and we're dividing that by 365 to see what the daily book cost is of units that we're producing, right, of that inventory. And then we're dividing that into the inventory, which gives us the number of days on average that our inventory is sitting there, right? And then we have our inventory turnover, slightly different look at this. So some people look at this differently. You can either look at it as sales divided by inventories. That is a very common way of doing this, and it basically says, well, how much sales are coming out of our inventories. A high number here would indicate that we have a high number of sales in low inventories. In other words, we're selling a lot. A low number would mean that we probably aren't selling a lot, right? We're stacking up inventory, and that inventory, as we increase it, that's just kind of like a zero return on investment, right? Because it's just sitting there. We're not making any money. Another way to look at it, though, because sales is a market value, we want to look at a book value, perhaps, and that would be looking instead of at cost of goods sold. So we would take cost of goods sold, and we divide that by our average inventory, right? So then we would just go find our inventories, smooth out our seasonality, and yes, take it. And you see the numbers a little bit lower, but the trend will still be the same. All right, so we'll take that one, that little bit more complex version. Collection period. So this is just going to be our average receivables. So we're going to take our average of our receivables, right? And we're going to divide that by our sales, right? So up at the top, sales divided by 365. And so it's basically saying, the average receivables that we have in a time period, let's just go ahead, divided by the daily sales, and that's going to tell us the number of days on average that it's taking to collect money from those who owe us money, right? So on average, we're getting our money from people in 31.5 days. So 365 days per year is used in this, but some people use 360, and some people even look at it slightly different. They look at it and say, well, 5 days in an actual work week when we collect money times 52 weeks in a year, so 104 let's see here, 5 times 52, so they look at it in terms of 260 instead of 360. So it would obviously be a more aggressive and conservative number because it's saying, well, these are the number of working days that we have to be able to collect on. So anyway, it's just different ways you can look at it. Receivables turnover. So receivables turnover is our sales divided by our average receivables, right? So it's just going to be our average and our receivables. Sorry, my phone is telling me that I have emails and I'm getting distracted. Okay, so average receivables divided into sales gives us our receivables turnover, and that's just telling us really, from a receivables perspective, how much money are we making. Days sales and cash. This one's going to be really important later on, and it's going to tell us basically how much cash do we have on hand for every day of sale, right? So let's look at that. You can look at it as cash plus securities. Here we don't have any securities, so we're just saying cash, and we divide that by our daily sales, right? So sales divided by 365, and that tells us that we have about 2.3 days worth of sales of cash on hand in general. And that will be really important when we start forecasting how much cash we need to have in the future based on the amount of sales that we have. All right. And then finally, we get our payables period, right? And again, this one can be done in slightly different ways. It says accounts payable divided by credit purchases divided by 365. What we can do is look at it as our accounts payable period, right? So here, our accounts payable divided by our cost of goods sold divided by 365, and that tells us that the number of days on average that it was taking to pay people, right? So we're paying this book value amount, the cost of goods sold, and we're tying that into our accounts payable, so what we're paying out to people, and dividing that by 365, and it's basically giving this kind of this number of that indicates whether we're taking a long time or a short time to pay, right? So let's go ahead and copy those to the right, ignore all those errors, and we can see some interesting things, right? We'll talk about those a little bit more on the next one, but in the meantime, I would suggest that as you're getting into looking at these days, you can take one decimal out of this, and it just makes it a little bit easier to digest some of these when you're talking about in days periods, because we don't typically think about days in terms of 2.5 days or something like that. We look at it as 2 days, right? We need to have 2 days or 11 days. Okay, so I will see you next time when we get to liquidity and leverage ratios. All right, bye-bye.